2025 has featured a roller coaster ride of tariffs, with US President Donald Trump hitting almost every country on the globe with levies, including at one point some uninhabited islands near Antarctica. He was going after the penguins. Everybody was initially concerned that these tariffs would slow global trade considerably, but our guest says global stocks ended up being more resilient than expected. Let's get more from Dec Mullarkey, Managing Director of Investment Strategy and Asset Allocation at SLC Management. Dec, great to see you. So there was a lot of bluster over tariffs. There was extreme pessimism in April, but markets came roaring back. The levies weren't as bad as people had thought.
That's absolutely true, Andrew. So first of all, great to connect. Great to see you. And maybe to channel a Dickens novel here, it was the worst of times, but it ends up at the end of the day on somewhat of a high note. The big surprise, absolutely, this year was the resilience of global economies to all of this, and including the U.S. The one thing I think that was key there is that the rest of the world didn't really retaliate. I mean, China certainly got tough, but most countries figured, okay, if we retaliate, that may just spiral. And in fact, we're really only, putting a tax on our own people, and that's going to be bad for our economy. So that's what was the key takeaway. And the real surprise out of all of that was markets globally performed phenomenally well. And we say, okay, the U.S. was, also hung in there, but it was the rest of the world that was the big surprise in all of that. And some of it was the weak dollar, and Canada was a standout there as well. So the essential thing was companies showed that they were able to tolerate some of this. Obviously, the initial hits that were put out there wasn't as severe as they ended up being. There was also this negotiation around it, and some were rolled back and some were mitigated in some fashion. But it was an interesting outcome, and that's where we are right now, heading into 2026 on that kind of solid note.
Emerging markets are one asset that benefits from a weaker U.S. dollar in the sense that some of those nations have debt denominated in U.S. funds, and they've done pretty well this year.
Unequivocally, they actually have, and that's been a big driver. Also, rates coming down, big benefit for them as well. But all of these countries really have some, significant output. I mean, if you look at some of the top performers, like Taiwan and South Korea, they're big chip manufacturers. So it's been part of that story as well that has swept over them. And Vietnam is a great alternative to China, and with some of what's going on, that's seen a big boost. So there's been a lot around it. And then Europe had the stimulus that was coming out of there. Again, that's more obviously a developed market, but even emerging market Europe, all of that kind of buckled up. And then so just because of the AI boom as well, demand for commodities, everything again gave a boost to South America. So a lot of it was coming together. It's, to your point, amazing in a way. No one would have thought that going into the year, but a lot of those effects really came together and just created this powerful year for the rest of the world, including EM.
One theme you're looking out for in 2026 is what you call AI monetization. What do you mean by that, Dec?
Well, the thing that everybody's focused in on so far as an indicator of how AI is going is, okay, how are these guys spending? How are the big hyperscalers? Are they getting, are they seeing kind of pass through? Are they seeing some demand around it? But the big thing that investors are now saying, okay, great, we see the spending, we know this is real, or at least you guys are committed to it, but how is this going to show through in real revenue? And there's some of it coming through, but investors really, really want to see more. They're basically showing how are we certain that there's going to be a return on investment, that it's not only from you and your products, be it Microsoft or whoever. We want to see this is broadening out to the rest of the economy, because otherwise it's not going to be this home run that we're all expecting based on the valuations we're putting around it. So it's very much going to be a year where people are going to demand a proof statement on where this revenue and cash flow is coming from. And you see it where companies haven't been so clear on that. Meta and Oracle are examples in their earnings calls. this last quarter. They weren't so clear on that, and they really started to see a discount in their stock price. So investors are already sending that signal that we want to see the pass-through on this, if you will, or the results from it.
Another theme you're looking out for, and it's really a continuation of something we've had in 2025, this so-called debasement trade. Do you think there will be ongoing worries about governments racking up big debts?
It will be. That issue is not going away. And of course, you showed gold there in your intro, and silver, if you put that there as well, has seen an incredible buildup. So both of those metals, as an example, and just maybe to elaborate for a second, debasement trade absolutely is the concern about that countries do not show any fiscal discipline, and that's a problem across developed economies right now. They're not showing that. They're playing into populism and spending as much as they feel the need to get voters on their side. But part of that is also that investors get concerned about that central banks will be too accommodating, and they really want to keep inflation under control. So that now has led to concerns about, well, what's our alternative to hedge against a bad outcome there? You could abandon markets, but what investors have been doing is playing into these precious metals because they think they're an alternative, if you will, to currencies that might be inflated away. And that's why gold and silver have had a great run. Some of that is central bank demand, but a fair bit of it is retail demand that's coming through ETFs. So I think that's going to continue, the concern around that. And at some point or other, bond markets will revolt and say, no more. We're going to just start pushing prices up. There's been some, or yields up. There's been some of that happening already, but I think we're going to see more and more of that type of pushback and demand for discipline as we play through 2026.
Dec, thank you very much indeed for joining us.
Super. Thank you, Andrew.
Dec Mullarkey, Managing Director of Investment Strategy and Asset Allocation at SLC Management.